Okay, here we go. So today's topic is Audit Responsibilities and Objectives. Now the chapter reference today, as you can see, is chapter 4. Okay. Now the topic in the chapter we're going through is talking about not only the responsibilities of the auditor, but also management. Because that's something I also want you all to understand. We have responsibilities for management as well as the auditor when it comes to conducting the audit. Now, something we're also going to look at today, the audit objectives, and that's going to be really, really important for you to understand. I'm going to explain things in a slightly different way to what you will read in your textbook. The reason is I want you to understand the concepts, and the way I'm going to explain them to you is hopefully a bit easier than how the textbook is technically trying to teach you. So on that note, let's begin. Now, these are the objectives today. As you can see, a few of these objectives have been crossed out. The reason is this. Sometimes when you are being taught theory, the theoretical way they are teaching you doesn't really align to how we do it in practice. So that's why I'm going to be teaching you things in a slightly different way, because it's actually more applicable to how you will think and how you will apply in real life. Okay, so that's why you see those 3 objectives in particular are crossed out. So hopefully the way I go through things with you today will help you better understand the concepts and the topics. So on that note, first thing we're going to talk about today is the objectives of conducting an audit. Now, before I go anywhere, ladies and gentlemen, your first highlight of the day, ASA 200. Oops, sorry. Do it bigger. ASA 200. Now, we have been starting to make references to your auditing standards. As I mentioned to you at the very beginning of the semester, I have created a list of ASAs I want you all to have access to. It's on UTS Online. Please make sure you refer to that list. And I've also included the link to where you can download the auditing standards. Ladies and gentlemen, let me ask you a question. Your final exam, is it open book or closed book? Exactly, okay? Make sure that you are downloading these standards because you will need them as reference points throughout your studies as well as in the exam. Okay, so there's a reason I'm providing that information for you. And on that note, today's focus is on ASA 200. Now, what ASA 200 states, and we'll highlight this one because it's important, it talks, so in particular paragraph 3, talks about the audit of a financial report. Now, we've spoken about this before. A financial report includes 2 things. It's the financial statements as well as what? What's the other thing that's included? Exactly. The disclosures, the written explanations that have been included in addition to the financial statements. Ladies and gentlemen, we're not just looking at the numbers. We're looking at the written disclosures as well. Please be mindful of that, okay? Your focus is not purely on, you could have gone this way. Your focus is not just on the balance sheet and the income statement. Your focus is on all those statements in addition to the written content as well. So on that note, what does ASA 200 tell us? ASA 200 says, let's go through this one together. The purpose of an audit is to enhance the degree of confidence of intended users in the financial report. Now, we've just spoken about the financial report, including the statements as well as the written disclosures. Now, what this is saying is that the purpose of what we do, the purpose of an audit, is to enhance the degree of confidence of the users. How do we do that? There are 2 main points of value that underlines an audit. The first one starts with an I. The auditor is what? Independent. The second one, the auditor starts with an E. What's that one? Beautiful. What is happening here is by having an independent practitioner, being your auditor, an independent practitioner with the expertise, so the skill to know what to look for, having this person come in and check the information makes the information more reliable, makes the information more credible. For who? The intended users. Now, let's see if you remember this from last week. Who are the intended users of the financial report? Shareholders. Let me ask you this. Is it the current shareholders or future shareholders? Excellent. Okay, wonderful. So that's basically putting it all into perspective. Now, the final thing I just want to highlight while we're here is that we're going to express an opinion, and that's called the audit opinion. We've started talking about those a little bit, on whether the financial report is prepared in all material respects in accordance with an applicable financial reporting framework. First things first, you know what? I'm going to do this in red. Actually, I'll do it in orange. Material. Ladies and gentlemen, I need you to understand this one. We are going to talk about materiality and the concept of material a little bit today, but more so in the coming weeks. Material means significant. It means important. Information is material when that information will affect someone's decision, and that's the key. Something is material, something is significant or important if it will impact on someone's decision, it will affect the decision that they make based on that information. Now, I just want to add one thing, ladies and gentlemen. If you didn't know this, write it down. Information can be deemed material based on two things. Its amount, so the number, I'll write this in. So it can be material based on its amount, so it could be a big number, or its nature. Something can be material because of its nature, okay? Not just the number, but because of what the information is relating to. Now, I'm going to give you a good example of that in just a moment, all right? So in this case, we're checking that the financial report is prepared in all material respects, in all significant respects, in accordance with an applicable financial reporting framework. What's the applicable financial reporting framework for us? What are we checking the information against? Say that again? AASBs. Guys, your accounting standards. Now, let's bring in what we talked about 2 weeks ago. The AASBs are called your criteria. Remember this from 2 weeks ago? Okay, they are the criteria. They are the information that we are using, they're the criteria that we are using to evaluate the information against, to determine whether the information is T and F. What's that? True and fair. That's exactly right. So if you really want to take this paragraph and link it back to 2 weeks ago, the subject matter of the financial report, is the financial report. That's the information we're looking at. We're comparing it or evaluating it against the criteria, being the accounting standards. We are coming up with a conclusion, being the audit opinion. That's for the intended users, being the shareholders. Okay, so you can link all of these elements back to the absolute first definition we went through. Now, on that note, let's go into what the process is. Okay, so this is here, the steps to develop audit objectives. I'm just going to cross out the word objectives because this is really the steps to develop what we call an audit plan. Okay? We go through this process to ultimately come up with a guide as to how we are going to conduct the audit. What are we going to do? Who's going to do it? When are we going to do it? What procedures are we going to conduct? What evidence are we going to collect? So all of this comes down to your plan, okay? Now, I'm not a big fan of how they've worded this, to be honest with you. So let me just explain this in my own way. The first thing we do need to do is we need to understand the responsibilities of us as the auditor, as well as management. And that's the first thing we're going to talk about today. The second thing is once we've done that, we actually divide the financials into cycles. Now, I'll take you through that. It's actually quite logical once we discuss it. Once we know kind of the sections that we're going to be looking at, guys, this is a word you're going to hear me say quite a lot today. I'll do it in yellow. And that is we need to understand management assertions. Now, before we go anywhere, I'm going to mention this now, and I will repeat this later. But an assertion, if you didn't know this, write it down. An assertion is a statement of what one person thinks is true. It's a claim or a statement that they think is true. Now, when I say management assertions, the whole financial report and everything that it includes are management's assertions about what they think is true. They're telling you this is the sales number. This is my assertion that this is the right sales number. This is my assertion that this is the right expense number. This is the right cash number. It's management's assertions about what they think is the true economic circumstances of the business, okay? We are going and we are testing those assertions. We are collecting evidence to see whether those assertions are indeed correct. And that's essentially the process. Now, we're going to break this down, but I just wanted you to have that oversight. So we look at what management is saying, and then here we do our testing. Okay, we collect our evidence. So that's essentially all I want you to know for now. On that note, let's talk about management's responsibilities. As I said at the beginning of class, both management and the auditor have responsibilities when it comes to the audit of the financial report. Now, what are management responsible for? First of all, they are responsible for adopting sound accounting policies, adopting or selecting sound accounting policies. Now, as we all know, the accounting standards give us choice. Let me ask you this. How many different ways can we depreciate an asset? How many? It's more than one. What is it? 3. Excellent, okay? Now, in the accountant to determine which of these policies or which of these methods they're going to pursue, that's up to them. So the standards essentially provide us with choice, and it's up to the accountant to decide, okay, which one's the best one for this business? Which one will best reflect the business? Now that is one of the most important responsibilities of management. They have to pick the policy or pick the procedure or pick the option that will best reflect the business. Essentially, what we're saying is don't engage in earnings management. Remember earnings management, it's the legal but unethical manipulation of your numbers, because what earnings management is doing is going against the intention of the choices being there. They're picking the option, they're picking the depreciation method, for example, that results in the number they want to show. But they should be picking the one that results in the best reflection of the true business. Okay, so one of the first responsibilities is that they need to pick the right policies. The second one, they need to, do this one in blue, they need to maintain adequate internal controls. Now, okay, notice I put my pen down. Internal controls, we're going to be talking about these a lot over the next couple of weeks, and I need for you to understand at least a little bit what they are. Ladies and gentlemen, this is my way of explaining it. A control is any task or any activity that a business puts in place to deal with a risk, okay? It's anything that the business puts in place to deal with a risk. Now, let me give you some examples. When you see the security guard standing at the end of a shop, what risk are they trying to deal with? Shoplifting, theft. Ladies and gentlemen, that's a control, okay? It's another one here. This is a control. This pass gives me access to my office and my floor where students aren't allowed to access. That's a control. What's the risk that it's trying to deal with? Unauthorised people getting access to secure locations. Anything that the business puts in place to deal with a risk is called a control. Let me give you one more. In business, many managers will have different authority limits. So if the business is purchasing an asset and the asset is $10,000, they have to get approval from the manager who's authorised to give a $1,000 approval. That's a control. Why do we need approval? In order to deal with the risk that people are just going to go and buy whatever they want for themselves. Okay, so all of these things, they're controls. Now you need to know this. We're going to build on this knowledge as we go in the next couple of weeks. Now stepping back, coming back to their responsibilities. It's management's job to put those controls in place. It's not the auditor's job. What we do, and you're going to see this next week, what we do is we come in, we look at the controls, and we determine, are the controls working or are they not working? Are they doing what they're supposed to be doing or are they not doing what they're supposed to be doing? But it's management's responsibility to put them in place in the first place, okay? And that's really important for you to understand. Final one, and we touched on this last week. It is management's, not the auditor, it is management's responsibility to make sure the financial statements are fair. What does that mean? They're truthful. If you go back to last week, we mentioned this concept of contributory negligence. Contributory negligence basically said that they were sharing negligence. It wasn't just the auditor's fault, it was also management's fault. Ladies and gentlemen, just because the financial report is being audited, it does not, I repeat, it does not relieve management from their responsibility, from their duty of making sure the information was right in the first place. Okay, that is their duty. Now, so much so By the way, it's management and directors. So much so it's their responsibility that directors have to sign a written declaration. Okay, and you'll see this in the financial report. They sign a written declaration essentially stating that yes, you know what, I'll show you here. They basically sign this declaration and they say, yes, the financial statements and the notes, they give a true and fair view of the financial position of the company, as well as the financial performance of the company. They also go on to say that, yes, it does comply with the accounting standards. Now, directors actually have to sign this document, okay? Now, you might be thinking, why do they have to sign? 2 reasons. Number 1, research into psychology has shown that by getting someone to sign something, they're more likely to pay attention to what it is that they're signing. So that's number 1. Now, that's pretty logical. Number 2, it's a legal document. In the future, if it finds out that they knew that it was wrong, that becomes part of the evidence to find them legally liable. Okay? So this document, this director's declaration, is something that the Corporations Act requires. So it's under the Corporations Act that this is now something that needs to be done. So management's responsibilities are essentially what we've just now covered. Let's move on to the auditors. Auditors' responsibilities. Now, I haven't included it in here, but just know that this is still talking about ASA 200. We're still talking about ASA 200, okay? And if you want, you can actually see this is paragraph 11, okay? So whenever you see, just FYI, whenever you see something that says ASA 200 dot and then a number, the second number is the paragraph reference, just so you know, okay? So in this case, it's ASA 200.11. And what ASA 200.11 says, and these are some concepts you should be pretty familiar with by now, is that it's the auditor's responsibility to obtain reasonable assurance. Now, we've talked about this concept so much the last 2 weeks. Reasonable assurance. Ladies and gentlemen, can we provide absolute assurance, yes or no? No. Do we test every single transaction, yes or no? We take beautiful. We take a sample. We test the sample, we come up with our conclusion based on the sample. We don't test every single sales transaction, every single purchase transaction. Why? Think about businesses like McDonald's. Think about businesses like Woolworths. It is physically impossible for us to check every single transaction. So we take a sample. By the way, sampling is a whole topic of its own, and we'll talk about that. I think it's after you come back from VC week. So we obtain reasonable assurance. It's not a guarantee. It's not absolute assurance. The level that we hold ourselves to is that of a reasonable auditor. Now, we obtain reasonable assurance about what? About whether the financial report, numbers and written disclosures as a whole is free from material misstatement. Now, this comes back. Let's talk about that, by the way. That's why we've brought it down here. Okay, material means significant. It means important, but let's take it one step further. Material means something that is significant enough to change a user's decision. Now, as I mentioned before, something can be material based on its amount, its number, it's a big number, or because of its nature. Now, let me link it to the word misstatement, and I'll come back to nature. Material misstatement. So that misstatement, actually, let's talk about that. A misstatement is either, now this is, you gotta be careful here. It's either the information is wrong or the information is missing. Please be mindful of that. If the Corporations Act says that this company must include this in their financial report and they don't include it, that's a misstatement as well. So it's not just when the information is there and it's wrong, it's also if the information is not there anyway. It's not there in the first place. So please be mindful, omission is a misstatement as well. Now, material misstatement, as I said, a misstatement can be material because it's a big number. So if I find, for example, a $2 million error, that could be material. But on that note, please be mindful of this, and if you want, write this down. Material is a relative term. It depends on the company. If I find a misstatement of $1,000 in Coca-Cola, probably not going to mean too much because Coca-Cola is a multi-billion-dollar company. $1,000 isn't really significant. It's not really material. But a $1,000 misstatement would be material if it's a really small business that works in a really local suburb and doesn't really make that much money. So it's all relative, all right? And I'm going to give you more examples of that when we actually go through the topic of materiality, but for now, that's what I want you to think about. So material misstatement. Now, as I said, a misstatement can be because the number is wrong or because of its nature. Ladies and gentlemen, the best example of something that would be material because of its nature, fraud. Fraud. Because I don't care how much the fraud is for, it's fraud. Let me give you an example. I had a friend who was a golfer. He was a professional golfer in Australia. And he worked at one of those golf stores that sell, you know, the golf equipment, like the putts and all of that. Now, one day, his name was Alex. One day, his actual name was Alex. So probably, you know what? His name was Diego. Let's go with that. So I saw Diego. I said, Diego, why are you so sad? And he said, oh, my friend Michael got fired today. I said, well, why did Michael worked in the golf shop as well? I said, well, why? He said they thought he stole $20. And I looked at him and said, how much money does that shop make? He said, $50,000 profit every month. And I said, 20 bucks? Really? And he said, yeah. And then it clicked to me. I said, you know what? It wasn't the $20. It was the fact that they thought he stole it. Because, ladies and gentlemen, there's two different types of fraud. First is theft. Second is manipulation of the numbers. Right? We're so prone to thinking, oh, they overstated or they understated. No, ladies and gentlemen, there's a type of fraud called misappropriation of assets. What does that mean? Theft of assets. Cash is an asset, right? So in this situation, Michael was fired not because of the $20, not because of the amount, but because of the nature of the act. So you need to be mindful that material misstatement is not just because of the number being wrong, it's also the nature of it that can make it significant. If I'm a shareholder of a company and I find out that there was fraud in that company, I really don't care if it's $500 or $100 or $20. I care that it was fraud. It's significant to me because of the nature. So please be mindful of those two parts of that concept. Now, going forward, look at this. It says, we're checking to see if there's financial report as a whole is free from material misstatement, whether due to fraud or error. Whether due to fraud or error. Ladies and gentlemen, if you didn't know this, write it down. Fraud is intentional. It's intentional. They meant to do it. It's very unlikely to find, oh, I accidentally committed fraud. All right? Error, mistake, unintentional. Okay? That's the difference between those two concepts. Fraud is intentional, error is unintentional. It's a mistake. Ladies and gentlemen, for the purposes of audit, it doesn't matter. The intention behind a misstatement is irrelevant. If the information is wrong, the information is wrong. It's a material misstatement, and that's why it says whether due to fraud or error. It doesn't matter the intention behind it. If it's wrong, it's wrong. Okay? And we are going to be talking more about that as we go along. And ultimately, we want to make sure that it's in all material respects prepared in accordance with the applicable financial framework, which is the AASBs. Okay, and remember that's your criteria. All right, so they're the key things that I want you to understand. And again, these are really important concepts because they're going to come through in our subject every single week from now until the very end. Okay, now on that note, the other thing. Another big responsibility that we have as auditors, and we've mentioned this concept before, is we must exercise professional skepticism. Now, we've talked about this particularly last week. Professional skepticism, ladies and gentlemen, 2 words, questioning mind. Questioning mind. What does that mean? We need to, there's one more thing I was going to tell you. No, that's all. Professional skepticism refers to, number 1, we need to be independent. Number 2, we must have a questioning mind. What does that mean? It means we don't just take their word for it. If management, so you know what, if I was the auditor of UTS and I was looking at the business building, so the big paper bag building, and the management said to me, oh, Mrs. Auditor, you're so pretty, but Mrs. Auditor, this building is worth $200 million. I don't just look at them and say, okay, right? I need to exercise professional skepticism, a questioning mind. I can't just take their word for it. I must get corroborating evidence to support what they are telling me, okay? We need to get evidence to support everything. And on that note, that is why we document everything. 2 reasons. Number 1, we need that assurance. We need to make sure that the information is good. Number 2, to cover ourselves. Because at the end of the audit, what do we give them? A what report? At the end of the audit, we give an audit report, good. And that's a legal document. As we discussed the whole of last week, that exposes us to legal liability. So we need to make sure that we have evidence to support all our conclusions. We have evidence to support our judgments, okay, of the procedures that we conducted. Because in the event that an allegation is made that you were negligent, we can say, well, no, we weren't. Here you go. Okay, here's all the information that supports my conclusion. So it's really important for us to do that. Now, I've got a line, there's a sentence that I read, I don't know if it was in the textbook that we're using this semester or another one, but it kind of, in my opinion, it wraps it up quite nicely. Let me read it for you. It says, the auditor should not assume that management is dishonest, but the possibility of dishonesty must be considered. Ladies and gentlemen, we don't assume that they're lying to us, but the fact that they can lie to us must be considered. That's professional skepticism. That's that questioning mind. You need to get support for everything they say. You need to get support for every single number that you are looking at, okay? And that's my way of explaining this, and there's more information that you can read about that. Have a critical eye. Remember, have a critical eye, okay? Now we go focusing on the auditor's responsibilities, particularly when it comes to material errors. Now notice that the word material keeps on coming out. Ladies and gentlemen, if we find a $2 mistake, that's not going to impact on our audit opinion, okay? We're only concerned with material misstatements, significant ones, whether it's due to its nature or its amount. But we don't think about every single little mistake. It's more the material ones that we are mindful of. I remember my very first day as an auditor, so embarrassing, my very first day as an auditor, they gave me a financial statement and they said, we want you to just make sure that the numbers add up. And I remember I went to my manager 3 times and I said, this is off by 1 cent. And they looked at me and said, Tia, go away. All right, so because 1 cent is not material, it's not going to change our ultimate opinion. So material misstatements is what we're after. Now, when it comes to material errors, remember error is, let me ask you, intentional or unintentional? Mistakes, okay? So where can errors come from? Well, they could be mistakes in calculations. They added things up incorrectly. They put a plus instead of a minus, or they added an extra 0 when they shouldn't have. Omissions, they forgot to include something. It could also be, by the way, duplications. If they accidentally record the same transaction twice, right? That's also an error. If they incorrectly summarize something or put an incorrect description, let me give you an example. They post it to the wrong account. That's also an error. Okay, so these things can happen. And on that note, let me just say one thing. Ladies and gentlemen, as long as you have humans involved in doing something, there's always a chance of error because we're human, okay? So these things, again, it's unintentional, but given the purposes of an audit is to find material misstatements, if these unintentional errors become material, that is still going to be something that will impact on our audit opinion. Fraud, I'm going to do this one in red. All right, fraud, but material fraud. Now, mind you, that's an interesting term to use because fraud in itself is material, right? Because of its nature, okay? First thing I would like everyone to do is to highlight or circle this reference. Ladies and gentlemen, ASA 240 is the auditing standard that deals with fraud. You need to know it, or you need to have it. You need to have it, okay? Make sure you download that one. We will be referring to it, and I really want you to have a look at it. In particular, and I mentioned this to you last week, in particular, when you go to the back of the ASA 240, there is an appendix. Refer to it. Go have a read of that appendix because there's what we call red flags are noted in there, and I'll refer to that again in just a little while. So when it comes to fraud, and I didn't mention this to you, but I'll just mention it here, we have 2 different types of fraud. Number 1, misappropriation of assets. Misappropriation of assets. Ladies and gentlemen, that's theft. Theft of assets. Now, what are some assets that can be stolen? Cash, inventory, they're probably the 2 main ones, okay? That's called misappropriation of assets, theft of assets. The second type of fraud, and that's the one that we're more familiar with, it's called fraudulent financial reporting. What's that? Manipulation of the numbers. Okay, manipulation of the numbers. Now that's the one that focuses more so on overstatements and understatements, putting the wrong number in. That's fraudulent financial reporting. But theft is also a type of fraud. So if you didn't know that, please make sure you note it down. We care about both of them, okay? Now this is interesting. What ASA 240 says is that for fraud to happen, there's often 3 elements. Now this is interesting. There are often 3 elements. What are they? Do this simply. First one is there's usually a pressure or an incentive to commit the fraud. All right? There's often a pressure or an incentive to commit the fraud. What does that mean? Let me give you some examples. Pressure. The pressure could come from if there's an individual that works at a company and they might feel pressure to commit fraud because they have a sick child. So they have a sick son or a sick daughter who requires really expensive medical treatment, which they can't afford. So that might be giving them the pressure to then commit fraud. It could be either stealing money or whatever it is. Another thing that could be pressure is if they're experiencing personal financial difficulty because of a gambling habit, giving them pressure to commit fraud from their workplace, steal money from their workplace in order to deal with that issue. Flip it over, incentive. Ladies and gentlemen, the number one incentive and something that we always look into as auditors is situations where there's the bonus structure is linked to sales. Now, if you watched one of my welcome videos, you would have heard something similar to this. But in any organisations, when there's certain sales targets that salespeople have to meet in order to get a bonus, that's a red flag. Notice the terminology I'm using. That's a red flag. Why? Because that gives them an incentive to overstate their sales, hit their sales target and get their bonus. Okay? So that's why as auditors we have to have a questioning mind. We need to look out for these suspicious indicators so that we can further investigate them. In that case, and if you didn't know this, write it down, any situation where the remuneration structure of the organisation is linked to hitting sales targets, we always look into sales. Because why? There's an incentive to commit fraud. Now let me ask you this, let's see if you learned. If they are overstating their sales to hit their sales target and get their bonus, what type of fraud is that? Good. Fraudulent financial reporting. It's the number one. Excellent, okay? If we're talking, go back to the example where they had a sick child and they're going to steal money, that's misappropriation of assets. So start getting used to the linking process throughout. Now, on that note, the next thing, so there's a pressure or an incentive to commit the fraud. The next element is there is a perceived opportunity. Oh, you know what? Let me give you one more incentive, actually. If someone really likes designer handbags or designer shoes or designer clothes, that might be an incentive to commit fraud as well, okay? Next one, perceived opportunity. What does that mean? They had an opportunity to commit the fraud, okay? They had access to the system to go and manipulate the numbers. They had access to the cash register to open it and take out the cash. They knew that no one was going to check. All of these instances, they're all opportunities to commit fraud. One more thing. You know how I talked about this? My security pass being a control? If there was no such thing and everyone could just walk into any building or any room or any, any storeroom where information is kept, that provides an opportunity to commit fraud because there's nothing stopping you, right? So there's often, for fraud to take place, there's going to be these elements that are present in achieving that. So an opportunity, so going back to the example I just used, if there's an opportunity that no one checks the cash register, the person can just go in and take the money out. That's an opportunity. Going back to something I mentioned last week, if you remember the self-checkout at Woolworths or Coles, where people were putting cherries through as grapes, remember that? That's because you had they had an opportunity, right? It was up to them. They go and they select which fruit or vegetable they are buying. Now, there is a person watching, but they're watching like 12 people at the same time, so they're not going to be as detailed. That's an opportunity. Now, stay with that example. Third one, rationalization or attitude. What does that mean? That is the attempt to justify the fraud in the mind of the person committing the fraud. So go back to the self-checkout. Those people that were putting the cherries, the expensive cherries, through as grapes and paying less money, they were thinking, Woolworths makes so much money. This is nothing to them, okay? Another one, go back to stealing the cash. I work so hard in this business, I could work at McDonald's and get more money. I deserve this, right? That's the rationalization or attitude. It's the attempt to justify the fraud in the mind of the person committing it. Ladies and gentlemen, for fraud to successfully take place, you generally have all three elements present, okay? And by the way, those three elements together are called the fraud triangle. Refer to the next slide. That's the fraud triangle. So you have them on each of these sections of the triangle. Again, ASA 240 is your reference. Ladies and gentlemen, when you go to the back of ASA 240 in the appendix, there is a big list. And what's the big list of? Red flags, indicators of things that look suspicious that might be indicating fraud. Please have a look at that. It is in the appendix. And you know what? It says it here. ASA 240 and red flags. I'll just mention that. Now, on that note, let me ask you a question. Ladies and gentlemen, let's see if you remember this. Is it the auditor's responsibility to go actively looking for fraud? Yes or no? No. Excellent. But we need to be aware of red flags. We need to be aware. We have a questioning mind. Remember, professional skepticism. We have to have a questioning mind. If there is a factor that we see, we think, that's a bit suspicious, we need to investigate. Now, let's see if you remember this one. The quote from the Kingston Cotton Mill case, the auditor is a watchdog, not a bloodhound. Excellent. Okay, we don't go actively looking for it, but if we do find it, or it does come up, we have to do something about it. Now, on that note, I keep mentioning to you red flags, red flags, red flags, you need to read, you need to read. I included a couple. Here we go. Now, I'm just going to mention some of these. The first one being, and this one's interesting, this. Oops, sorry. This is a very interesting indicator of something not being correct. What is it? Key finance personnel, particularly payroll, by the way, particularly payroll personnel, are refusing to take leave. Now, I love you all, right? You know I love you. And I love what I do. But I don't love it enough not to ever take leave, okay? Now, particularly someone that's in finance and does payroll for a living, if they're refusing to take leave, that's a bit weird. I judge that person, right? Now, why is this really important? Because the question then becomes, well, why don't you want to take leave? Are you trying to hide something? And by the way, many companies have a policy that they're pretty strict on. You have to take regular leave. Let me tell you why. A lot of the big frauds that have been uncovered, guess when it was uncovered? When they went on leave. And someone came into their position, took over the role and thought, that's really weird that this money is going into this other account, right? So if personnel or key people are refusing to take leave, that's a big red flag. You know what? Let's do this in red. That's a big red flag, okay? So you want to be investigating that situation thoroughly. The other one I want to mention is poor compensation practices. Now, if the business is not paying their employees well, that gives rise to, here's the concept, incentive to commit the fraud, right? So they're not being paid well, that gives rise to an incentive. The only other one I really want to mention is this. We talked about controls. If the business, number one, if the business doesn't have controls, if it doesn't have things to deal with the risk of fraud, or if they do but they're really not very good, that's a red flag, okay? We want to be looking into that situation because that gives rise to, here we go, opportunity to commit the fraud. Start using the terminology, start seeing the links because that's how you're going to understand it, okay? And that's fraud. Now, final bit here about auditors' responsibilities is their responsibilities for discovering illegal acts. Illegal acts. Now, when it comes to our responsibility for illegal acts, it actually depends. It depends on whether those illegal acts have a direct effect on the financial statements, has a direct effect on the numbers, or an indirect effect. Now, those that have a direct effect, and by the way, let me give you an example. If the company breaches tax laws, if they breach tax laws, which means they're not paying or they're not reporting the right amount of tax, off the top of your head, can you think of a particular account on the financial statements that would be impacted? If it's tax? Say that again? Yes, good. What else? Tax. Think of tax and a word after it. GST, definitely, yep. Tax expense and tax payable, that's absolutely right. Ladies and gentlemen, that's what I mean by direct effect. It's going to actually impact directly on a number, right? So in those cases, when it will have a direct effect, we have a responsibility, a reasonable expectation is on us to investigate, okay? When it has a direct effect. When it has an indirect, now let me explain this one. Indirect basically means it's out of our scope of expertise. A good example of this is if the business is breaching some environmental law. They're polluting the environment, or they are releasing waste into a river, something like that. It's kind of outside our scope of expertise. In that regard, we don't have an expectation on us to find it, but even though there's no expectation on us to find it, if it does come to our attention, we have to do something about it. And that something about it is generally reporting, okay? So if a legal activity, and we mentioned this last week, if an illegal activity comes to our attention, we must report it. Now, who do we report it to? It depends on what the illegal act relates to. If it's a financial illegal act, ASIC. Okay? If it's an environmental one, then the EPA, the Environmental Protection Agency. If it has to do with, what's another one? If it has to do with fraud, we would talk to the board of directors of the company, and we'd also talk to the audit committee, and then perhaps to ASIC as well. So it kind of depends on what it is. But essentially, for our purposes, I want you to understand the different responsibilities on us. If it has a financial impact, we have to do something about it. Well, we have a reasonable expectation to find it. If it's indirect, then it's not so much as an expectation, but if it does come to our attention, we must do something. Amanda has this quote that she always says, if you see something, say something. It's almost like she needs a badge to do that as well, okay? Now, okay, here we go. Ladies and gentlemen, I need you to shake your head or do something. This is important. Not to say that all the rest of it wasn't important, but this is incredibly important. How do we do an audit when it comes to the financial statements? Ladies and gentlemen, there are two approaches that we can take. So, you know what? Let's do this. I'll do it down here. Okay, so let's just focus on two of the financial statements. The first one being the P&L, so the income statement, and the second being the balance sheet. Now on the P&L, let's see if we remember this one. On the P&L, what do we find on the P&L?
Income expense.
Beautiful, revenues and expenses. Remember that, revenues and expenses. If you need to, write it down, but I hope you don't need to. Revenue and expenses, okay? On the balance sheet, what do we have? Assets, liabilities, and? Good, equity, I'll just say. Just equity. Okay, great. Now, why did I do this? Number one, what we just put up is going to help you go through the next section. Number two, when we perform an audit, the approach that we take, we have two approaches. Now, the first approach is we can actually go and check every single number individually. So we can check cash as the cash number individually, accounts receivable individually, prepaid assets individually. So we can go through individually and test every single one of those accounts. The other is to do what's called the cycle approach. Okay, and what the cycle approach does is it actually groups together the accounts that are related, and we actually audit them together. Now, which one do you think is more efficient, individually or cycle? Yes. And that's why in practice, you actually have audit financial cycles that we look at. And that's what you're going to see in the next slide, because it's more manageable. What's another word for manage? It's more efficient. It's more efficient, okay? So that's why we do it. Now, on that note, if you don't understand what I mean by accounts that are related, we did this in literally week 1. Ladies and gentlemen, if I perform a service, so I have an educational organisation and I perform a service, right? Now, what's the journal that I record to recognise the fact that I've provided you that service? And you haven't paid me yet? Accounts receivable is the debit, good. And what's the credit? Beautiful. Why did I just do this? Ladies and gentlemen, these two are related. Revenue and accounts receivable are related, so they are part of the same cycle. Why is this important? Double entry accounting helps you in audit. Why? Because if you gain confidence, if you get evidence that gives you confidence that the service revenue line of this journal is correct, you've actually just supported the fact that the accounts receivable line is also correct. You get evidence for one, supports the other. That's double entry accounting. That helps you be more efficient in the audit. And that's why these two accounts are grouped together in the same cycle. So you're going to see what I mean as we go along, but I wanted to provide that example. So it says here cycle approach. Cycle approach. Now, these are the various cycles, okay? Now, I'm going to be quite brief here because we will be talking about these quite a lot going forward, but sales and collection, ladies and gentlemen, things like accounts receivable, sales revenue or service revenue, things that relate to anyone, so sales discounts, sales returns, thinking about accounts receivable, the allowance for bad debt. All of these accounts that are kind of related to one another, they all sit in the same cycle. They're on the same family. Okay, so you can think about it that way. This is us turning all the individual accounts into families, and then we deal with each of the families. Okay, acquisition and payment cycle. Acquisition and payment generally deals with all your expenses and your payable accounts because they're related. You generally have an expense and a payable together. Interest expense, interest expense, interest payable. Tax expense, tax payable, right? So you group them together. Payroll and personnel, wages, wage expense, wage payable, or if it's salary expense, salary payable. All the leave entitlements, so annual leave payable, sick leave, all that stuff, okay? That's all together. Inventory and warehousing, all the different types of inventory. We've got raw material, we've got work in progress, we've got finished goods, or it's just inventory. COGS is related to that as well. So the more you use, and this is why I told you in week 1, accounting is here, auditing is here. In order to succeed in this subject, you really need to go back to your basic accounting knowledge. That's really going to help you, I promise, okay? So if you don't remember these things, go back and revise because you'll need it if you want to start understanding these concepts better. All right, so they're basically all the different cycles. And again, we will go through this as we go on. This one, I'm not the biggest fan of this, but essentially what is being said is that a transaction happens, okay? We then journalize it. We do a debit and a credit in order to record that transaction. That journal is then summarized into your ledgers. That goes into your trial balance, and then ultimately that is what's used to prepare your financial statements. Now, why is this important? Ladies and gentlemen, in order to gain confidence that the information here is correct, we go back through this cycle, okay? Now, I'm just going to mention this term. I will mention again later, not today's class, but going forward, that what we just did there, when you start at the end and you work your way back to supporting documentation, that is called vouching. Write that down. Vouching. Vouching is when you start with the finished records and you vouch your way back to all the supporting documentation. Why? Because that gives you confidence that the final number is correct. One more thing I'm going to mention, and again, don't worry if it's not absolutely clear because we will come back to it, but we can actually do the opposite. We can start with the journal, we can start with the transaction or whatever it was, and we can work our way to the financial statement. That's called tracing. So when you go up from the beginning to the end, it's called tracing. From the end back to the beginning, it's called vouching. This is only your first introduction to it. I wasn't even going to mention it today, but just note it down and you'll see as we go along that makes logical sense. And I will revisit this going forward. Alrighty, here we go. Now, what I want to focus on in this slide is these ones, the different audit objectives. We have audit objectives in over 3 main categories. Those 3 main categories are transaction-related audit objectives. You know what? I'm going to reword this. I encourage you all to write this down. Instead of calling it transaction-related audit objectives, can you please just call them income statement transactions? Income statement transactions. Because these objectives refer to your revenue and your expense transactions. And that's why I asked you before what goes in the income statement, okay? This first category focuses on income statement transactions, which is all your revenue and your expense transactions in and out. The next one, it says balance-related audit objectives. Let's rephrase this, guys. Balance sheet items and balance sheet accounts. Again, that's why I asked you before, what goes in the balance sheet? Your assets, your liabilities, your equity. So the objectives we use surrounding your assets, your liabilities, and your equity fall into that second category. The final one is presentation and disclosure. Now, this one's interesting. When you step back, we don't just look, like I said at the very beginning of the class today, we don't just look at the numbers in the balance sheet and the income statement. We look at the whole financial report. That includes the written disclosures. So this third category focuses on how the financial report has been presented and how the disclosures have been included. Have all the disclosures that the Corporations Act required or accounting standards required, have they been included? So this one in particular focuses more so on the words, okay, the written disclosures, but also the overall presentation of the report. So we will be looking at all 3, but our focus is on these 2, okay, the first 2. And that's what I'm going to talk about today. Now, okay, I mentioned something to you at the very beginning of class, and I said that when the management prepare the financial reports, they are making assertions about what they think is true. Now, what does that mean? When management prepare the financial report, they are saying, this is the sales number I think is true. This is the expense number I think is true. This is the cash number I think is true. They're assertions. An assertion is a statement of what one person thinks is true or a group thinks is true. If you go back to last week, or was it the week before? I don't remember. Any mother, when it comes to their child, what do they say? My baby is the cutest baby in the whole entire world. They are making an assertion. They are making a statement of what they think is true. We, as auditors, we go in and we test those claims. We test that information to determine whether it actually is true or not. Now, where am I getting to? Ladies and gentlemen, in order to test that information to see whether it's actually true, we use what's called, audit assertions. Now, I'm going to say one thing to you. Audit assertions, you're going to hear this concept today, obviously, next week, week after, then you get a break, you come back, I talk about it again, and the week after that, and the week after that, and the week after that, all the way to the end of the semester. Audit assertions are the foundation of what we do. So you really need to understand what is going on with these, and I'm going to spend a bit of time to make sure that you're at least getting a good introduction to it, okay? So we use audit assertions. Audit assertions are kind of, if you want to think about it, they're characteristics of truth. It's the characteristics we use to determine whether the information is indeed correct. Now, it's going to make more sense as we go through. There are 3 categories. Here's the first one. Oh, by the way, it's covered in ASA 315. Okay, so please make sure you have access to that. It's a very big standard. So here we go, first one. Now, before I go into it, can you please write something on the top for me? Can you please write, when it says here classes of transactions and events, please write income statement transactions. For now, that's going to make it easier for you to understand. So here we are talking about the characteristics we look at to make sure our income statement transactions, our revenues and our expenses are correct. Now, here's the thing, very logical, incredibly logical if you just think about it. Okay, so here we go. And I'll give you examples as we go along. First one, the first assertion, audit assertion, is occurrence. What does that mean? Did the transaction really occur? Did the sales transaction really take place? Was it real? Was the sale really made to a real customer? Now you might be thinking, what are you getting at? One of the ways, I was going to do an exercise with you, but I'll just mention it anyway. One of the ways that people or management or salespeople can overstate their revenue is by including what we call fictitious sales. Fictitious sales is fake sales. Fake sales go against the occurrence assertion. Okay? So what do? We check, did the sale really occur? Was it real? Was it made to a real customer? Second one, completeness. Oh, that's terrible. Completeness. Were all the transactions that were supposed to be included, were they included? Is the account complete? Okay? If any transaction is missing, that's a breach of completeness. Now let's bring it into context. Expenses. Have all the expenses been recorded? Are all the expenses complete? All right? So we're starting to see some links here, and we're going to work on that a little bit more. Completeness. Everything that should have been included, has it been included? Accuracy. One way I want to talk about this, accuracy is making sure that the transactions have been recorded at the correct dollar amount. At the correct dollar amount. So if they record a sales transaction that was worth $100 and they accidentally include an extra zero to make it $1,000, that's a breach of accuracy. It's the incorrect dollar amount. Next one, cutoff. Let me ask you a really quick question. If I sell tables, so I've got a business and I sell tables. Now, if Diego comes to me on the 29th of June, he comes to me and says, Tia, I want to buy 5 tables. I say, great, fantastic. Pay attention to the, should I write it? Yeah, let's write it. So let's just keep track of the dates that I'm saying because this is important. So on the 29th of June, Diego says, I want to buy 5 tables. I say, great, fantastic. I'm really busy, so I actually end up looking into my warehouse on the 2nd of July. I find the tables that he wants and I ship it to him on the 4th of July. Oops. And he pays me, because he's such a great guy, pays me on the 6th. Ladies and gentlemen, when do I record the sale? You know what? I want more people involved. We're going to do a vote. Everyone raise your hand. Don't worry, you're not going to get marked on this. It's just for engagement, okay? So raise your hand if you think I have to record the sale on 29th when he called me and said, Tia, I want the tables. Okay? All right? The 2nd of July was when I checked my warehouse and I got the order together. When do I record it then? Okay. On the 4th of July when I deliver it, raise your hand if you think that's when it happened. Okay. And 6th of July when he paid me. Fantastic. If you didn't know this, please make sure you write it down. We record a sale upon physical transfer of the goods. Okay? If it's a physical good, we record it once it's been transferred to the customer. Why? Because title has transferred from me to them, okay? And that means I have earned the revenue, okay? Why are we talking about this? That's cutoff. Cutoff is making sure that I've included it in July and not June. Cutoff is making sure the transaction has been recorded in the correct accounting period, in the correct time frame, okay? And finally, classification. It's been posted to the correct account. So if I recruited a marketing firm to come and do an advertising campaign for me, I have to record that expense as marketing expense, not interest expense. That's classification. So we're checking, did the transaction really occur? Have all the transactions been completely recorded? Were they recorded at the correct dollar amount? Were they correctly recorded in the right period and in the right account? Ladies and gentlemen, those are the 5 characteristics of truth when it comes to income statement transactions, your revenues and your expenses. I can't stress that enough for you. That's going to help you understand much more easily. So that's income statement transactions. Now let's move on to balance sheet. When it comes to balance sheet, there's only 4 assertions. The first one is existence. Does the asset really exist? Now let's go back to me being the auditor of UTS. I'm the auditor of UTS. I come in and I say, what's this building 8? What's this business building you speak of? And they say, oh, it's just down the road. I'll walk you to it. I go to the building, I see the building, I say, the building exists, okay? Does the asset really exist? Existence, first assertion. Number 2, rights and obligations. Now, this one is a little bit tricky because it's linked. So let me just highlight it. Okay. What does this one mean? Does the business, now listen very carefully, does the business have the right to record the asset? Okay. Or does it have the obligation to record the liability? Now, let me explain this one to you. A business only has the right to record an asset if they own the asset or they control the asset. Why am I telling you this? If they have leased the asset and they're paying a monthly fee for that leased, let's say it's leased computers or a leased machine or something, but it's not actually theirs, they do not have the right to include it in their balance sheet. Okay? So it's really important. They have the right to include the asset, which means they either own it or they control it, or they have the obligation to record the liability. What does that mean? They have to pay for it. Yes. So leasing, there's two, who here has done ASR? Yeah, so there's 2 different types. Have you done it yet? Okay, there's 2 different types of assets. There's a finance lease, 2 different types of leases, a finance lease and an operating lease, right? So with one of them, it comes with you basically gaining ownership similar to ownership of the asset, which means you can record it as an asset. With the other one, the ownership stays with the person you're leasing it from, which means you can't include it as an asset. You can use the asset, but it's not yours. So you can't include it in the balance sheet. So that's when this comes into place. Let me tell you one more. So my family, we used to have a family business. Okay, and we used to sell Manchester. Now, we used to enter into something called a consignment relationship. Does anyone know what consignment means?
Yeah.
What does it mean?
The seller doesn't own the goods.
Excellent.
Under the manufacturer.
Excellent. He said the seller doesn't own the goods, it remains under the ownership of the manufacturer. What does that mean? For example, the manufacturer or the supplier, I should say, the supplier would say, look, I'm going to give you these products. If you sell the product, then pay me. If you don't sell the product, just return it back to me. Now, why is that important? Because the business that's holding the product, they don't own it. It's called consignment. Consignment means they only gain the ownership once they sell it. But up until the point that they sell, it's not theirs. They don't own it. They don't have the right to record it as inventory. Do you see what I mean? So please be mindful of these things, and your tutors and your textbook will help you with that as you go along. But that all links back to the rights and obligations assertion. Next one, completeness. You'll notice you've heard this before because it sits under both. Completeness, making sure that all the assets, all the liabilities and all the equity items that you should have included, you have. There's nothing missing. It's complete. Finally, valuation and allocation. Now this one very similar to something we've discussed, in that this is also talking about making sure that it's been recorded at the correct dollar amount. So it's very similar to accuracy that we found in the other one. But the word is not accuracy, the word is valuation. Let me explain this one to you. Even though they're talking about a very similar concept, which is the correct dollar amount, this is the difference. Accuracy is much more straightforward. Accuracy of a sales transaction, you can check whether that number is correct by just checking it against the invoice or checking it against the quantity that they purchased times the price that they paid. It's pretty straightforward. Valuation is a much more complicated process. Let me ask you this question. This is, you know what, you would have learnt this in Accounting B, so a couple of years ago now. But when a business purchases a non-current asset, so they purchase a piece of machinery, do they put the value that they put in their assets, is that just how much they paid for the machinery, yes or no? No. What else do you include? The cost, so there's a cost that you paid, what else? Installment, transportation, what else? Beautiful, excellent. All the costs necessary to put the machine to use. Ladies and gentlemen, with non-current assets, the value that you record in your balance sheet includes the price you paid for it, the purchase cost. In addition to any cost you incurred in getting the asset delivered, installed, and ultimately ready for use. It's not just the one number. You have to add all of these elements. Let me ask you one more question. Throughout its life, what happens to a non-current asset? Starts with a D. depreciation. Do you see what I mean? It's a much more complicated process, and that's why we use the term valuation, okay? Accuracy is more straightforward. Valuation is more complicated. There are multiple elements involved, and that's the distinction. Now, I'm going to say this one more time. Accuracy is in relation to an income statement transaction. Valuation relates to balance sheets. Please be careful with that, okay? They're very common mistakes that people make. Now, the final element here is allocation. If you want just above it, just write allocation relates to current versus non-current. Allocation is very similar to classification, which is what we had in the last one. It's talking about whether it's been put in the right spot. Now, because we're talking about balance sheet, allocation means has it correctly been recorded as current versus non-current? Guys, go back to last week. Remember the case where the PwC partner was banned for 3 years? It was because Centro had done what? Who remembers? Sorry, who remembers this? Excellent, yes. So they had incorrectly included $2.1 billion of liabilities as non-current when they were actually current. Ladies and gentlemen, it was an allocation problem, okay? It was an allocation problem. So that's what we're talking about. These are the characteristics we use to determine whether the information is indeed truthful, okay? Now, the final category is presentation and disclosure. In saying that, there's just a couple of things I want to bring to your attention. Number one, presentation and disclosure relates to the overall financial report. It's not specific to income statement or balance sheet, it's the overall financial report. In saying that, it relates to how the financials are presented as well as the written disclosures, the written notes that go with them. And it basically is looking at have they done everything in accordance with the accounting standards in how they should present the information. Now notice I'm not going through it because look on the note that I've included on the right-hand side of your slide. I mentioned to you that ASA 315 is the standard, but ASA 315 changed at the end of last year. What has happened? All of this, that was terrible. All of this is now being incorporated into the other two categories. So it's no longer a category, I don't like that. It's no longer a category of its own. It's now been included into the other two. Now in saying that, because your textbooks are still showing the information in this way, I don't want there to be unnecessary confusion. So for the purposes of how we're going to teach you, we'll stick to this, but going forward, just be mindful that ASA 315 no longer has this category. It's now been included in the other two. But for the purposes of your learning and consistency with the textbook, just be mindful we will keep it to the three categories. Now, as I said before, our focus will be on the first two, on the income statement transactions assertions and the balance sheet account assertions. But as you read this, you'll notice very similar. The wording is very similar to what we've already gone through. So I'll let you have a read of that, but again, the focus will be on the other two, okay? Now, what I've done is we've included this slide for you so you can see the similarities between the two categories. Now, this is really important because I want you to start seeing the links. It's only through seeing the links that you're truly going to understand, okay? Now, once I go through this with you, I'm going to go through a little exercise because as I said to you all last week, knowledge doesn't become understanding until you apply it. So we're going to do a very little exercise, so you're going to start seeing how this can actually be quite logical. Once you start applying the knowledge, you'll start understanding. So here we go. First one. Occurrence and existence are linked. This one, occurrence on the left, is talking about did the sales transaction really occur? Was it real? Existence, does the asset really exist? Is it real? That's the connection. So they're both talking about very similar concepts in the sense of, well, is it real? Did it actually happen and is it real? So those two are related, but again, they sit on two different categories. Completeness and completeness, they're the same word. Have you included everything that you were supposed to include? Is anything missing? Completeness. Accuracy and valuation, we mentioned this just a little while ago. They both talk about making sure it is the correct dollar amount. The only difference between the terminologies is accuracy is more straightforward. Valuation, you need to include a few elements. Now, allocation, so this one, is kind of linked to classification. Classification, making sure it's in the right account. Allocation, making sure it's correctly allocated as current and non-current. Cut-off and rights and obligations. Cut-off, making sure it was recorded in the right period. Rights and obligations, making sure it was recorded because it had to be. They had the right or they had the obligation. Okay? So they are linked, but I want you to be mindful of where each one sits. The ones on the left under transactions, they're income statement transactions. The ones on the right, assertions relating to balance sheet items. Now, here's the activity we're going to do. Guys, all of this is logical if you just think about it. You don't even need a lot of accounting knowledge to do this one. What I want to do, I'm going to note down, how am I going with time? Okay, I'm going to note down a few categories. And what I want you to tell me is what would management do to these categories if they wanted to make the business look good? Okay, so I'm going to say category and I want you to tell me whether they would overstate or understate if they want the business to look good. Okay, so would they show a higher number or a lower number if they want the business to look good? Now bear with me, this will help you. First one, assets. What would they do to assets? Overstate or understate? All right, overstate, good. Liabilities, good. Revenue, fantastic. And expenses, excellent. All right, I do have a reason for this, I promise. And here's what I'm trying to get at. Let's go into assets for a second. Ladies and gentlemen, can you think of if they want to overstate their assets, if they want to show they've got more than they actually do, how would they do that? What's the way that they can overstate their assets?
Revaluation, fair value.
Okay, so talking about the revaluation, yeah? So revaluating it as fair value rather than historical cost. Awesome, here's your link, let's apply. What assertion would that be? What would it be, Jeanette? Say it again. Beautiful. Valuation, right? Because it's talking about the dollar amount. So that one would be linked to this, okay? So a way that they can overstate their assets is by messing with the number that they've recorded the asset for. That's a valuation assertion. What's something else that they could do? How? Excellent. UTS could say, oh, we have building 20, 21, 22, 23, 24. Do we actually have those buildings? I don't know. We could. We have a lot of buildings. But let's say no. That is an existence issue. Ladies and gentlemen, all these risks that you are talking about, they link back. And that's what I want you to see. As soon as you start seeing the link between a risk and an assertion, you're halfway there. Okay? Let's go to the next one. Let's go to revenue. How can you overstate revenue? And by the way, there's 3 ways that you can overstate revenue. What do you think? Sorry? Yes, fictitious sales, what we talked about before. They can include fake sales. Which assertion is that breaching? Excellent. Notice what you're doing. Revenue is on this side. Oh, sorry, you can't see that. Revenue is on this side. Assets was on this side. Okay, good. Now, keep going. What else can you do? So you can include fake sales. What else can you do to overstate revenue? Think about if the sale is for $100, you might record it as $1,000. Accuracy. Include it at the wrong number. Excellent. One more. Go back to the Diego example. He ordered it on the 29th of June. I delivered it to him on the 4th of July. If I included it on the 29th of June, which assertion is that breaching? Cut off. That's exactly right. Guys, start seeing the links. It's really going to help you, okay? Now, let's just jump over to the other side. It's less. Liabilities. How do we understate liabilities? There are 2 ways. Number 1, there are 2 ways of understating liabilities. Number 1, good, valuation and allocation, excellent, including a lower number for your liabilities. The second one, what is it? Completeness. Why do you say completeness? You're right, but why? Not including everything. That's it. Not including everything. That's a completeness issue. If you have $10 million worth of liabilities and you only include $9 million of it, that's a completeness issue. You haven't included everything. So with liabilities, there's two ways that you can understate. You include it, but at a lower amount, which is a valuation issue, or you don't include all of it, which is a completeness issue. One more thing. Expenses. There's 3. I'll do this one very quickly. With expenses, number 1, you can include the expense at the wrong number. That's accuracy. Number 2, you cannot include the expense. That's completeness. Number 3, you can include it in the wrong time period. That's cutoff. Okay? Ladies and gentlemen, all of these logical risks that we see, I want you to start linking it back to the correct concepts. That's step 1. Once you're able to do that, the next step is to design the procedures to test it. And that's going to be what we're going to be doing in the next few weeks. So that's just an intro for you. So we've got one more thing to go through. All right, last one. How audit objectives are met. All I really want to say here is that what we develop is an audit plan. An audit plan. And what the audit plan does, it basically guides how we're going to do the audit. We set out what procedures are we going to do, who's going to do them, when are we going to do it, how are we going to do them, okay? So that's all I really want to tell you about. That's the audit program. Now, when we design our procedures, we design the procedures to gain comfort over each and every assertion. So we have procedures that are focused on making sure the assets really exist. We have procedures that are looking into whether the sales transactions really occurred. That's the link. So I need you to start understanding the assertions because the procedures are the next step, okay? And everything is linked. The more you see the links, the more effectively you will understand and do well in this subject. And my job is to show you, is to help you see those links. So as I said, the audit plan is basically a guide as to how we're going to do the audit. Final thing I'm going to go through before I let you go is this. Number 1, stage 1 of the audit, which is what we're going to talk about next week, it's planning the audit. It's the planning stage. And essentially that's when we come up with our audit plan or our audit strategy. Now, ladies and gentlemen, the first thing you need to know, the very first thing we do as auditors is we gain an understanding of the business. We need to know how they work. How does their business function? What are the processes that they do? Because it's only once we know that we're able to see where are the risks, what do we need to look at. That's step 1. That's planning the audit. Once that happens, step 2 is the testing stage. So step 2 is the testing stage. That's when we actually do all of our evidence collection and we conduct all of our procedures. Once we've done all of that, the final stage is the completeness stage. What does that mean? We look at all our evidence, we evaluate all our evidence, and we come up with our audit opinion. Now, our audit opinion is in what document? Yep, it's a legal document called the audit report. That's absolutely right, okay? Oh, let me just ask one question. How many different types of audit reports do we have? 2. Which one's the happy one? Unmodified. Which one's the sad one? Beautiful. We're going to build on that as well. Guys, you've been brilliant. Let me ask, before you back away, the reason I finished just a little bit earlier is because I want to make a really quick announcement about your video interview assessment. It will start next week. I'm actually going to send out an announcement tomorrow about it. Now, what I want you to know, everything that I've gone through today is included in the content that can be covered in your video assessment. Now, why am I telling you that? Because I want to wait until you've done your tutorials on this topic before I make the assessment available to you. I want you to have the understanding from not only the lecture, but also your tutorials to make sure you're a bit more comfortable. It will include all topics up to and including this one. I will give you more information in the announcement, but please make sure there's the FAQ. The FAQ document is up and I've included a lot of questions about it, and I've also got a student guidelines document up on UTS Online. Have a look at that, but I will send an announcement tomorrow as well. Well done, guys. Have a fantastic day. I'll see you next week.